Hi all, I am Sham and I have Kishan with me. Welcome to this week's episode of Free Float. This is, a very strongly opinionated piece that we put out this week. It is about how, as an individual investor, in this environment that we find ourselves in, you hold all the cards, right? There was a time when there was a big difference between the information that was available to, say, an investment bank in Wall Street versus what was available to a fund manager versus what was available to an individual investor. And there was a big difference between commissions that were charged to bigger clients versus commissions that were charged to retail and so on. And then there was multiple steps in the intermediation process where products designed in Wall Street or in Boston or in Mumbai or something would go through multiple hops before it reached you. So that landscape is completely shattered right now. There's really no, I would say, no information arbitrage, so to speak. That's number one. Number two is there's growing evidence that most of what people thought worked, right? Uh, it worked because of information asymmetries, right? So they would just give it a fancy label, like my mutual fund outperformed because I did all this research and so on. But fundamentally, it was because they had access to more information than anybody else, right? But that is no longer the case because multiple rounds of regulation has made sure that information is available to everybody at the same time. Now, combine that with low cost or zero cost, trading abilities. Most of the old funda of, create a low churn portfolio and sit on it, all that bullshit coffee can investing and all that stuff. Um, the kind of alpha that it could add, such concepts could add, is almost zero given the current situation. And not only that, uh, in fact, working in a institutional money management firm is a net negative to alpha generation. So part of today's post sort of walks you through why that is, right? The biggest reason is when you get into this money management thing, the biggest problem there is the agency problem. Kishan, I'm sure you've come across this agency problem, right? Because
Yeah.
the whole independent advisory model was set up to overcome this agency problem. So can you walk us through what that is?
Yeah. So I mean, agency problem comes from having conflicts, right? So you have a, say, a mutual fund distributor uh, who whose business comes from the incentives being misaligned to to the client's needs. For example, a mutual fund distributor has the incentive to sell you an equity product versus debt product because the equity product has a much higher like incentive for him.
Right. So
Right.
in finance, So in finance, pretty much every player, right, has an agency. There is an agency problem there. So
Yeah.
a broker is incented to make you trade as much as possible because that means more commissions to him. A distributor has the incentive to sell you high margin products for him, whatever gives him more commissions, right?
Also,
So, yeah.
yeah. Also, I think it goes even higher. I think fund managers pay if it's highly skewed towards like, a performance linked pay, he'll he's going to be more incentivized to take more risks than than what you would ideally like,
Right.
because and also the fund manager, if it works, he gets a higher pay. If it doesn't work, at the most he'll get fired. It's so you have in many ways, you do have this misalignment, which is why the concept of mandates came along.
Right. So mandates, is something that we go deeply, into the post. But quite simply, mandates. Think of mandates as putting a fence around your fund manager. Do's and don'ts, right? So if to tell you why this is important, I'm sure most of the older or members of this audience would have heard about Vic Niederhofer, right? So he is supposed to be some sort of a savant genius. He's got a Twitter handle which is bonkers. He wrote a book about sports betting, betting on horses, and how that translates to investing and in life and everything in general. The book is a completely rambling, bizarre book, but everybody praises it, like, oh man, this is like groundbreaking and all that. So that dude, he set up not one, not two, but three hedge funds, and each one of them blew up spectacularly. Why? Because his favorite thing was selling out of the money put options. So he would do all these calculations, probability this, probability that, and this market, that market, but ultimately it boiled down to selling out of money puts. It would work great for like 2 or 3 years. So he would generate like 30%, 60%, and he would go and market the hell out of it, saying, I'm such a genius, look at me, making money is so great. And then year three, spectacular. So after attracting all the money from on year two, so this is a prime reason why mandates exist. Because what happens is most investors invest in funds with great 3-year or 4-year or 5-year returns, without looking under the hood. How has those returns been generated, right?
Right. Also, I think
doing this.
Also, I think, Sham, I think most investors with large ticket sizes have have not the objective of maximizing return, but preservation of capital is far more important than earning a high return, right? So yeah. So I think when you see, I mean, it's my biggest pet peeve that people compare the S&P 500 return to what some funds perform, but that's a different topic for different day.
Yeah. So the biggest problem with not having a mandate is you end up with these kind of situations where the fund manager is incented because he gets paid a bonus at the end of the year, right? So year one he gets paid, year two he gets paid, year three who knows, right? There's this favorite famous acronym that was, I think, featured in The Big Short as well, which is IBG YBG. I'll be gone, you'll be gone, right? So so they actually subpoenaed that guy who had written it, and well, explain this to me. It just means that I get paid bonus this year, I don't know what's going to happen 3 years from now. I'll be gone, you'll be gone. So a lot of this is of the mandate driven investing process is to make sure that the fund manager doesn't stray too much from what he promised at the beginning. If he says he's going to invest in large cap tech in the US, above $1 trillion market value or whatever, right? So take that in writing and make sure that the fund manager sticks to it. So that's that was the reason why the whole mandate process came about. And you don't want this guy going and selling puts and selling covered calls and dabbling in the futures market and buying currencies and so on. So the mandate process came about to kind of protect investors from this kind of misbehavior from fund managers. Now the problem is that every kind of restrictions you put, right, also means that the opportunity set available to the fund manager keeps shrinking, right? Uh, well, first of all, it's no longer the case where it's just a fund manager and you. So there are like half a dozen other stakeholders in the mix. Now what if a fund becomes very big and blows up, right? It invariably means that it's either some investor protection fund that needs to make good, or the taxpayer has to bail out that fund, which we've seen happen quite often in the US, right? Everything from money market funds to hedge funds on the brink of being blown up have been bailed out using taxpayer money. So every time this happens, the taxpayer or the government, right, they say, okay, we need additional protection so that this doesn't happen again. So the opportunity set available to the fund manager through this mandate process is keeps shrinking. And that's one thing, right? So you have the agency problem, and to counter that, you have mandates. Now the problem for an individual investor is that look at what happened to large cap alpha, large cap mutual fund alpha in India after SEBI laid down the rules for for mutual fund classification. So for people sleeping under a rock, from late 2017, SEBI came out and said that every mutual fund can have only one fund in each category, and these are the categories, right? And they also said that for example, you have a large cap fund, you have a mid cap fund, and a small cap fund, right?
Yeah.
Big three classes. Now you can have only one fund under each of these, and you can't have like some 10 different funds, large cap funds, calling themselves different things, right? So and also, if you call yourself a large cap fund, then the market cap that you're allowed to play in, the playing field is this. It's a fixed set, right? So you should have 80% of your fund in this large cap universe, and you're allowed to play in the mid cap space with the remaining 20%. And what is mid cap is also defined. So everything is defined, right? So given this, mutual funds went through a lot of collapsing of different, merging of different funds into each other to meet that mandate, and after that have not been able to beat the index. So what happened then? So what used to happen was they would say, large cap funds, they would go and invest a bulk of their funds in mid caps, which are high beta. So when there is a mid cap mania going on in the market, they can handily beat the indices. And then when they felt that it was petering out or something, they could reduce it and go back to being a pure large cap fund, so on and so forth. So they had a lot of flexibility before, which they lost. And combined with position level limits, like they can't have more than 10% of of the fund in one particular stock, right?
Yeah.
So people have been pointing this out, saying that Reliance's exposure in the Nifty 50 is upwards of 15% or whatever, whereas if you're an actively managed fund, you're only allowed up to 10%. So if Reliance goes on becoming a multi-bagger, then obviously your fund is going to underperform the index. So there are a lot of regulatory sort of forbearance driven decisions that drag down returns for institutionals managing money, right? So there's a lot of things going on in the background that prevent professional money managers who are allowed to manage money for other people, prevents them from beating the index. It's primarily driven by the balancing act between different stakeholders. And it's not just mutual funds, it's also PMS and AIFs and so on. They all have a whole bunch of rules that they need to follow, that reduces concentration risk, reduces blow up risk, and at the same time that also reduces the pool of alpha available to them. So it's a fascinating thing. Now the problem is not about mandates. It's as an individual investor, what I've seen people do again and again is labeling themselves, right? So it's not that somebody else called them a value investor or a micro cap investor or a momentum investor. They themselves call themselves, oh, I'm a momentum guy, so I'm going to do only momentum. Yeah. So the thing is, the single biggest
Like, why did you?
advantage, right?
Yeah,
Yeah.
There's great Warren Buffett quote, right? Which you would say that if I had a smaller pool of capital, I'll be outperforming the S&P 500 by a wide margin, because then I am not constrained by by the thing that that constrains me with the large pool of capital, where I'm like the fiduciary, holder of those assets. And I think for most individuals, saying I'm a value or momentum guy, and the thing is, you're saying that to yourself, and you're putting those constraints on to yourself. I mean, no one's told you that you should be this or that person. It's just, and it's not also that I think it's just that some philosophy appeals to you, so you become a convert, but you don't. But you don't have to be that convert.
Yeah, exactly my point. So it's not a religion, right? You can be anything you want. And why kind of build this wall around yourself, right? And the person building the wall is you, because you're not answerable to anybody else, right? So that's number one. So why restrict yourself to any one style of investing? Number one. Number two, even within that subsection, right, that you try to wall yourself into, there's no clear definition of what it is. I mean, just Google value investing, right? You talk to 20 people, you will get 20 different definitions of what value investing is. And right now, even people have given up, and they're like saying, actually value investing is growth investing. It's all investing. The idea of investing is to make money. That's it. So we are all investors. There's no growth, there's no value. In fact, value means embedded growth that other people have not found. So
you seem very passionate about this, Shah.
Yeah. So basically, the thing is, there is no. We are trying to come up with labels and so on and so forth, thinking that we are in a mechanical or a physical world. But investing and financial markets are not that. Financial markets are completely chaotic. They are complex. They are adaptive. You doing something in the market changes the market, right? So this is something that is lost on most people.
So I have a counter question to you. So say most individual investors or most either don't have the time or the inclination, right? To get into go deeply into investing, to read about strategies, or to experiment or to find the right strategies that work. And if you tell the average person out there that I buy companies, or you should buy companies that are, that are undervalued, and which are trading below its, historic mean valuation, or something. And this is a high quality company, and it's more likely to go up back to its mean rather than go below further. Most people would find that thing appealing to them, because from their understanding, that's something that makes sense logically. Say more than even say momentum investing. It's a big leap of faith. So I think most people, I'm not saying people on Twitter, but if you on outdoor, if you go and tell people that that's what I do, people would find that okay, that makes sense. That or maybe someone's looking for hobby, that's where they would start.
See, that is it's so it's a bit like this, man. You can start wherever you want, right? You can start in trend following, you can start in momentum, you can start in value. But my point is that just because you started, that doesn't mean you stay there, right? So and it doesn't take that much time, because there's so many resources online that is putting out quality content for free. If you wanted to really educate yourself, you can do that. And second of all, it really depends, I feel, on the age group, or the person's sort of life experience as well. So momentum investing skews towards the younger crowd, because that's all they have seen in their life, right? Their whole life is for momentum, in momentum game. So they have seen that, career wise as well, right? So success begets success. Nobody's going to give Bharat Ratna to a loser selling BDs, or whatever, right? So it's basically success begets success. And it doesn't matter how so most of the guys who are in campus recruitment and all, they veer towards companies that are already successful. They'll never go work for a small corner shop IT company, thinking yeah, so it's value, I'll grow with the company, right? Nobody says that. Everybody wants to work for JP Morgan or Morgan Stanley or whatever, right? So so it's very so if you I think it skews based on your own life experience. And at the same time, just because you started somewhere doesn't mean you only do that, right? So you have to be constantly trying to expand your horizon. And third thing is, what is the downside, right? Most Indian investors don't invest, they top out at 5% of their net worth in the equity markets. Okay, so what is the downside in in making less, right? So if Nifty goes up by 10%, you tried something, and you made only 5%, what big difference does it make to you? At the end of the day, most of your money is stuck in your apartment and your other fixed asset. You go buy some land somewhere. So your first inclination when it comes to investing is to buy fixed assets, gold and so on. Very late in the game do you even think about equities. So so that is one thing. So the actual amount of the percentage of your wealth tied up in equities is usually small, especially when you're starting off, right? It's very small. So goofing up at that point is not going to hurt you. Feel free to goof up, try different things, it doesn't matter. And also, this relative value game, trying to figure out relative outperformance versus something else, is there to to pay asset managers. It's a way of paying asset managers, saying if you outperform the Nifty by 2% for 3 years, then I'll pay you X, right? But as an individual investor, you're not playing that game. The only thing that matters to you is actually it is absolute returns. So because that relative value fellow, if the relative return asset manager, if the index falls 10% and his fund falls only 8%, he still gets paid that bonus, right? Because he won the relative returns game. But for you, what matters is absolute returns. You'd rather not lose that 8% to begin with, right? that relative returns hardly makes any difference to you. Beating the Nifty by 2% when Nifty is down 10% is not what you would normally call successful. So it makes sense to sort of, especially when you're starting out, investing, refuse to label yourself, try different things, understand how each one works, and figure this thing out for yourself, right? And don't expect some fancy fund manager to deliver any alpha to you. There used to be a time when it was possible, but what has happened over a period of time is all those advantages have been kind of snipped away. And right now the only advantage that a mutual fund has is the pass through tax status. That's it. They don't have to pay tax on the P&L generated by their churn, whereas you as a direct equity investor will have to do that. That's the only advantage that they have, and in spite of that they're not able to generate alpha in certain asset classes. So it makes sense for you to actually educate yourself and do this yourself, rather than depend on an institutional framework to deliver these things for you. So it's about time that people start spending time in kind of looking after their own wealth, and looking out for different strategies and so on.
Right. Okay.
So yeah. So anyway,
I agree with what you're saying. That the best thing that an individual investor has, or the smaller investor has, is being nimble.
Right.
That's as big as it.
Yes. So with that, enjoy today's post. We'll catch you again next week. Sorry if it came out as a rant, but I hope it was it was a meaningful conversation. Bye.
Yeah.